Hi students, this is budgeting part 2. We are going to see budgeting systems. We have incremental budgeting, zero-based budgeting. These two are related. Incremental budgeting, zero-based budgeting. Then fixed, flexible, flexed budgets. Activity-based budgeting, rolling budgets. There is one called periodic budgeting. These two are related. Let's see one by one what each of them mean. First one is incremental budget. Very simple. Look at this. If you are going to prepare the budget for 2026, you take previous year, that is basically the current year, actuals. Take each item, sales, material, variable cost, labor, everything. Just make necessary changes for each item and prepare the budget. The changes are for what? One, volume. Sometimes the company is growing. There is a 20% growth in volume. So each variable item has to be increased by 20%. Okay, increase it. Second, inflation. There might be inflation. Prices are going up year on year. 5% inflation. Then increase the prices by 5%. Your new budget is ready. 2026 budget is ready. You are not analyzing each item. What is this item? Why are we spending? How are we spending? No. Last year is taken as the base. We did this last year. We are going to repeat the same stuff this year also. Okay. So same figure should come. But if the volume is increasing, make allowance for that increase. If there is price inflation, make allowance for that price inflation. Your budget is ready for the next year. So incremental budget means based on current year. It builds in slack and inefficiencies. What is slack and inefficiencies? Suppose last year there was some inefficiency. Some department was not working efficiently. They were idling. But that is what you are going to take as the base. Based on that only you are preparing the budget for next year. Which means the inefficiency you are carrying forward from one year to another year. You are not removing it, you are not eliminating it. That is what this point says, builds in slack. Suppose for example, 60% efficiency was there in one department, labor efficiency. You are taking this as the base and next figure is set. So next year also you are just allowing 60% efficiency. If you did not identify this. This is incremental budgeting. Relatively straightforward, not taking much time, faster, easier. This involves adding a certain percentage to last year's budget to allow for growth and inflation. It allows slack and wasteful spending to creep into budgets. I already explained these points. Now connected to this, what we have, zero-based budgeting. So let's jump to zero-based budgeting and see what it says. Zero-based budgeting. Remember, zero-based budgeting can be tested in section B questions also. So pay attention. If you are going to prepare the budget for 2026, don't take any year as the base year. Don't refer to 25 or 24. Suppose if 2026 is the first year of business, suppose, assuming if it is first year, how will you prepare the budgets? Each item you will start thinking. For example, marketing. What are the ways of marketing? How much is the expense? How much is the benefit? Okay, this we will do, this we will not do. Right, so this is going to be the budgeting, marketing budget. That's how you are going to prepare each item. Production, material. Okay, who are the available suppliers? Let's analyze each supplier. What are the cons and pros of each supplier? So who is the best? Choose the supplier and put the material budget. So every item you analyze from the scratch. You don't say last year we did this, so we are going to do this year also. No. You analyze from the scratch and prepare the budget. So the definition is this. A budgeting system in which every item in the budget is justified. This is the most important term in this definition. Justified by the managers. What is the meaning of justified? You analyze. Okay, what's the benefit of doing this? What's the cost of doing this? Should we do this? Yes. Okay, let's do it. Justify. Is this activity required? Is the benefit outweigh the costs? No, let's not do it. Leave it. So it doesn't come to the budget. Build up budget from scratch. Allocated resources effectively, because there is not going to be any waste. Suppose last year you had some inefficiency, doesn't matter. This year you are not carrying forward that inefficiency. You are not taking previous year's budget or actual as the base for the next year. So you are not building in, you are not carrying forward any slack or inefficiency from one period to another. It is suitable for discretionary spendings. What is the meaning of discretionary spendings? Look, very important. There are some expenses which are routine type of expenses where whoever the manager, same expense will happen. For example, production expenses, direct material, direct labor. There's nothing you can do. Product is already designed. You know how much material it is going to consume, how much labor it is going to consume. The production manager cannot play much about it. Those are not discretionary. Discretionary means marketing expense. That is not standard. That is not routine. If I am the marketing manager, what I will spend, if you are a marketing manager, where you will spend will not be the same. Could be different. So it's in manager's discretion. Manager decides when, where, how much to spend. His decision, right? Such expenses are known as discretionary expenses. And zero-based budgeting is very much useful for such expenses, discretionary expenses, because you are justifying, you are analyzing. Routine items, probably incremental budgeting would be good. This approach treats the preparation of budget for each period as an independent planning exercise, meaning what? You are not connecting to previous period. The initial budget is zero. Basically, you take a blank paper. You are not taking from last year's figures. You start with a blank paper, zero. And every item of expenditure has to be here justified in its entirety to be included. Do we need this much? What's the benefit? Every cent you are including is going to be justified. Right. Then we have steps. There are past exam questions even asking you to explain these steps. Let's see what these steps are. Let me take marketing expense itself. And let's try to apply this zero-based budgeting. Let's say we have a budget allocation for marketing of $10,000 for this year for EULA tutors. Okay. Or for the next 3 months, let's say. So first what I will do, identify the decision packages. Decision packages is what are the different options I have for marketing. What activities I can do. Okay, let's say some Google ads. Okay, 1. 2, say some Facebook ads, Facebook promo. 3, Insta promo. 4, some influencers, paying to some influencers and promoting. Likewise, I consider different options, right? These are known as decision packages. Decision packages. Each is a package. Why I say package? This one now I will analyze. How much is the cost of it? How much is the benefit from this? Compare these two. Is it justified? Do that for each item. Cost, benefit, cost, benefit. Based on all these cost benefit analysis, now I can rank. That is step 2. Evaluate and rank the packages. Identify the cost and benefit of each of them. See which has the ratio highest. That means benefit over cost. If this ratio is higher, it's good. So which has the highest ratio of benefit to cost? Just rank them. For example, say this is 1. I'm randomly putting in 3, 4. If this is how it is, rank. Then you said $10,000 you have planned for your budgeting, marketing. Okay, in this order you allocate. For this you allocate whatever the requirement for this. Let's say this activity requires $2,500. Then go to second package you have chosen, this fund. Say this needs 5,000 pounds. This needs 4,000, but you don't have 4,000. 7,500 is finished. So you put another 2,500 here. Finished. Your funds are finished. You will not do this activity. That is step 3. Allocate resources according to the funds available and the ranking of packages. So once again, see, identify the decision packages. What are decision packages? Different activities we can do to carry out a particular task. Different ways of doing it. And see, these different methods or different activities could be, or different packages could be mutually exclusive or incremental. Mutually exclusive means what? There are 2 packages. Either you can do this or do this, not both. This is called mutually exclusive packages. So the packages you consider might be mutually exclusive or incremental. Incremental means I do one activity. Okay. On top of that, I can do another one. See, the example I have taken, all are not mutually exclusive. Incremental activities. I can do Google ad. On top of that, I can do FP promotion. On top of that, I can do Insta promotion. On top of that, I can pay to the influencers also. None of them are mutually exclusive. All of them are incremental packages. So it was tested in MCQs once. MCQ said, true or false, I think. In zero-based budgeting, decision packages we consider must be always mutually exclusive. True or false? False. It can be incremental packages also. So identify the packages. Second step, evaluate the cost and benefit of them. Rank based on that. Ranking, that is step 2. In that rank order, you allocate the resources. Advantages of zero-based budgeting. Identifies and removes inefficient and or obsolete operations. It identifies and removes inefficient or obsolete operations. Why? You are not referring to last year. You are analyzing everything from the scratch. So any inefficiencies will be removed. Provides a psychological impetus to employees to avoid wasteful expenditure. Now managers will know what the budget is going to be prepared based on analysis and justification. So I can't include any slacks. I can't include any inefficiency. I have to be careful. I can't waste anything. This mindset is created. So there is a mental lock that they will not think any wasteful activities. Leads to a more efficient allocation of resources. These are advantages. Sometimes they even asked you to write the advantages in section B. Be prepared. Disadvantages, a lot of time it takes. Every item, if you have to justify and analyze it, it's going to take a lot of time. Can cause suspicion when introduced. Now managers might think, why are they introducing this? Are they going to catch us something? Are they going to catch us on something? Doesn't the top management trust us? Why are they doing this? See, suspicion. When you are introducing for the first time, it can create suspicion. Cost and benefits are different. Alternative courses of action can be difficult to quantify. Now see, this marketing plan, let's say, okay, a particular advertisement, let's say I'm going to put a billboard on the road. I know the cost of it, okay. Benefit is very difficult to quantify. How much is the benefit? How many people are going to see that? How many of them will be converted into sales? How much sales is going to come through this billboard? Difficult to say that. So that's what this is. Cost and benefits of different alternative courses of action can be difficult to quantify. Ranking can prove problematic because it's very subjective. Since the benefit is not quantifiable, somebody might say, no, compared to Google ad, Facebook is better. Somebody might say, no, Facebook, Insta is better. So ranking can become problematic. And managers may not like it because of this suspicion factor. Why are they doing this? Are we losing all the freedom? Are we being questioned on everything we are doing? A marketing manager might say, look, I don't have to justify everything to you. Give me the $10,000 and wait for the year end. I will show you the results. Maybe he is very confident, right? So then every item being justified, sometimes managers may not like it. These are disadvantages of zero-based budgeting. Clear? So we have done incremental budgeting and zero-based budgeting. Let's go back to the order. Incremental finished. Then I went to the zero-based budgeting. Now coming back to fixed budget and flex budget. Fixed budget is very simple. See, for the next quarter, if I am making a budget for sales, how many units it's going to be? If I assume 5,000 units will be sold and prepare all the budgets like material, labor and everything, this is fixed budget. Why fixed budget? Does not change. Only one number of units are there. The problem, are you sure about 5,000 units? No, I'm not 100% sure, but I think it's going to be 5,000 units. Then we go to a second step. At the planning stage itself, then we say, okay, if you're not so sure about 5,000 units, what are the different possibilities? 4,000 is possible, 5,000 is possible, 8,000 units is also possible. Now I prepare 3 budgets. Still budgeting, no actuals. Still budgeting. Since I was not sure about it, I identified different possible number of units. Now I am preparing material, labor, overheads, etc. So this budgeting is known as flexible budgets. Flexible budgets. So what is flexible budget? It shows the cost and revenues for different number of units. Not only one number of units, it shows for different number of units. Flexible budgets. Fixed budgets prepared on the basis of an estimated volume. Only one estimated volume. No variance of the budget are made. Only one budget. They are not adjusted to reflect actual activity levels. Flexible budgets. Budgets set for several activity levels. Planning tool enabling what if scenarios. So what is this flexed budget? Okay, let's go back to that example. Now we are coming to the month end. Month or whatever the period end. This was at the beginning, right? What I have written here, this was at the beginning. End has come. You collect the actual record. Actual says 4,780 units were sold. So if you look at these budgets, none of these budgets are exactly matching with this volume. You considered 4,000, you considered 5,000, you considered 8,000, but the actual is 4,780. Now what I will do, I'll take all this data and prepare another budget. At the end of the period, again I'm preparing the budget for that period which is finished. For how many units? 4,780 units. See, actual units has to be matched and prepare another budget. Why am I doing it? Then I can consider line by line comparison. Apple to apple comparison. 4,780 units, what's the actual cost? 4,780 units, what is the budgeted cost? And I can find the variance. So this budget is known as flexed budget. At the end of the period, when actual number of units are known, you prepare a budget for that same number of units, which is known as flexed budget. Restate budget based on actual volumes. Useful for control. I told you in my last video also. Control means what? Comparison. Comparison of actual results with budget. So this is what is most useful for comparison. Without flexing it, if you just compare with something else, the units won't be same. Can you compare 4,780 units actual results with 5,000 units budget? Doesn't make sense. So if actual and budgeted units are same, then only I can compare it. So it's useful for control purposes. Like for like comparison and meaningful variances. Many times this is tested. They have given, sometimes they give report like this. Budget 2,000 units. Actual 2,100 units. They compare these two and give you the variance report. Variance. And then one of the questions would be, do you see any problem with this variance report? How would you correct it? Explain. So you have to explain, okay, this is the budget for 2,000 units, but the actual results are for 2,100 units. So anyway, the cost and revenues will be different. By comparing these items with different units, doesn't make sense, explain that. Flexible budgets. Budgets which by recognizing different cost behavior patterns change as activity levels change. I already explained different activity levels, you prepare the budget. You can read this, you can go through this. Tianjin Beer has a bottling plant for its beer and has prepared flexible budgets. See, 10,000, 12,000, 14,000 units, they have given you the budgets. If actual production was 12,350 bottles and the production cost incurred total 90,000, okay, total, not one by one. What is the meaningful total variance for performance evaluation? Now you see, I don't know whether each of these items are fixed or variable or semi-variable. Now this I can see fixed, 20,000, 20,000, 20,000. So if you are preparing a budget for 12,350 units, which is flexed budget, this straight away I can say 20,000. It has to be 20,000. Okay. Other items are not fixed. I can see numbers are changing, so definitely it's not fixed. But is it variable or semi-variable? I don't know. So how do you find variable or semi-variable? If cost per unit is same, constant, then it's a variable cost. If total cost is constant, that is a fixed cost, which is what I applied for this one. Total cost is. If neither these conditions are satisfied, none of these conditions are satisfied, then it will be a semi-variable cost. Check here, 30,000 divided by 10,000 is 3. 36,000 divided by 12,000 is also 3. 42,000 divided by 14,000 is also 3. So in all the cases, unit cost is 3. What did I write? 12. 3. Unit cost is 3, 3, 3. Since cost per unit is same, it is a variable cost. So here also I can multiply by 3 and write the answer. 12,350 into 3 will be 37,050. But if you look at this one, here it is 2.7 when you divide. This one if you divide, around 6, 2.6. It's not the same. This one if you see, it's 2.5. So unit cost is not the same, total cost is not the same. It's not a fixed cost or variable cost. So it's a semi-variable cost. Semi-variable cost, you have to apply high-low method. How do you apply high-low method? Look here. Variable, this is for labor I am applying. Variable cost per unit is the difference in cost between the highest and lowest. 10, 14, 35,000 is the highest cost, 27,000 is the lowest cost, 14,000 is the highest units, 10,000 is the lowest units. Cost difference divided by unit difference. So 8,000 divided by 4,000, it's $2 per unit, variable cost per unit. To find the fixed cost, what do? We apply this formula. Total cost equals fixed cost plus variable cost per unit into number of units. These are small workings, that's why I'm doing on the screen itself. Right. If I apply for this 27,000, total cost is 27,000. Fixed cost we don't know. Variable cost per unit, just now you found it to be 2. You are applying for how many units? 10,000 units. So this is 20,000. Subtract on the other side, 27 minus 20, 7,000. Fixed cost is 7,000. Now you found the fixed labor cost, variable labor cost. Now we can find for 12,350 units. How? Fixed cost 7,000. Variable cost per unit is 2. You want it for 12,350 units. Altogether, if you do this in the calculator, you will get 24,700, 7,000. 31,700 you will get. That 31,700 has to be added here. Now you can add all of them together. 37, 31, 68 plus 20, 88,750 is the total I am getting. And they say the total cost is 90. So actual is 90. Flex budget is 88,750. Definitely actual is more. 90,000 is more. How much more? 1,250 more, which is adverse. Compare 88,750 the flex budget with actual. It's a cost. Having more cost is adverse. So 1,250 adverse. So here I have done item by item, right? Another student can do this directly the total also. How? Get the total here. 30, 77,000. Get the total here. 40, 70, 97,000. Straight away apply high-low method for this one. And get the total cost for 12,350. Do you want to see how? Let's take some space. Where can I take the space? Okay, I'll do it here. Look here. 10,000 units. The cost is 77,000. What is the next activity level? 14,000 units. 97,000 units. All together I am applying variable cost per unit is get this difference 97, 77, 20,000. Get this difference, units difference 14, 10, 4,000. You get $5. Variable cost is 5. Now you apply total cost equals fixed cost plus variable cost per unit into units. Whichever the one. I like 10,000. Let's go with that. Total cost 77,000. Fixed cost plus variable cost per unit 5. 10,000. 50, 77. So fixed cost is 27,000. So altogether you found the fixed cost and variable cost. Now let's find for 12,350 units. 12,350 units. How? Total cost equals fixed cost 27,000. Variable cost is 5 per unit. Multiply by 12,350. So this is 61,750. 88,750. Is that the answer we got there? Yes, 88,750. So MCQs and all, when you are getting, if this is an MCQ, I will not suggest doing it one by one and wasting your time. Get the total cost, straight away apply high-low method to the total cost like I have done here and get the answer. Suppose if it is in section B, where say 4 marks allocated for this, then better do it one by one and show them the answers. Clear? That's flexible budgets. You can see the answer they have done one by one: material, overhead, labor, high-low method. One by one they are doing it. Zero-based budgeting I already explained. Finally, activity-based budgeting. Activity-based budgeting means, you remember we studied activity-based costing. If you don't remember, please go back, watch that video and come here. What is activity-based costing? The overheads you analyze into different categories, like procurement related overheads, machine running related overheads, machine setup related overheads, delivery related overheads. Likewise, you take different categories. For each of them, what do? You find the total overhead. That's what you call pool, cost pool. Then you find the cost driver, find the rate. Based on that you absorb. So this is ABC. Now if you want to do ABB, activity based budgeting, let me take one and explain. Say delivery cost. You want to budget how much is going to be the delivery cost next year. First thing, estimate number of deliveries. How do you estimate number of deliveries? You would have already estimated how many units you are going to manufacture. You know on average in one delivery run how many units are delivered. Say you are making some bottled juices. You might have already planned next year we have to sell 5 million bottles. And you know one truck carries, let's say, 10,000 bottles. So you can divide and tell, okay, so altogether 5 million divided by 10,000, 500 trucks or 500 deliveries have to be done. That is what I mean here. Estimate number of deliveries. Basically cost driver. Number of delivery is the cost driver. You do more and more delivery, you need more and more cost. So estimate the cost driver. Then based on past experience, you know cost per delivery run how much. That means if the truck goes once for a full round, how much is the cost of it? Running cost, salary of the driver, salary of the loading, unloading staff. How much is that? You know that. How? Based on past. Now multiply these two. You know one delivery's cost is here. number of deliveries expected here, multiply these two, that will give you the budget for delivery. Multiply 1 and 2, that gives you budget for delivery. Once again, what is 1? Number of deliveries. How did you find that? Based on number of units you are going to produce and how many units are taken in one order, one delivery. Second one, cost per delivery run. Based on past experience, check your last year, you will know how much. Multiply these two, that will tell you how much you have to budget for delivery. This is known as activity based budget. So basically using ABC information, this is what ABC information. Using ABC information for budgeting is known as activity based budgeting, which is being explained here. You can pause the video and read it. Rolling budget and periodic budget. This is the last one in these budgeting systems. Rolling budget. Let's first look at periodic budget. Periodic budget means if it is a 2025 budget, you have one full budget, 2025. This is the budget. You prepare it here. You wait until here for it to finish. Then you compare the actuals. The biggest problem with this, let's say after 4 months have gone, certain things have changed. Technology changed, competition changed, a new competitor has come. Still, you can't change anything on your budget because it was one single budget. So 4 months finished, can I take and change the rest 8 months? I cannot. This is the problem with periodic budget. So what we do, rolling budget, take this year, let's divide it into either months. Months means I have to divide by 12. I'll divide it into quarters. Quarter 1, quarter 2, quarter 3, quarter 4. So at the beginning what you do, you prepare 4 quarterly budgets, not one full budget. 4 pieces of budgets. Quarter 1 has a separate budget. Quarter 2 has a separate budget. Quarter 3 separate budget. Quarter 4 separate budget. So anyway you're going to have 1 year plan, but not in one budget, but 4 pieces. If it is monthly, you will have 12 budgets. Jan, Feb, March, April until December. Then wait until 31st of March. When you reach 31st of March, this budget is expired. That period is over. So now how many budgets you have? 3 budgets you have. First thing first, what is it? Check if market conditions have changed. Check if any of your assumptions have to be changed. Then update these budgets. Inflation has been different. Okay, this is gone, but these are all separate budgets. Update each of them individually. Update them. After updating, don't leave it there. Add another budget here. Which is this budget? You already had Q2, Q3, Q4. This is Q1 of next year. Next year quarter 1 budget is added here. Why is that? To ensure always you have 1 year plan with you. Similarly, when quarter 2 finishes, you will already have 3 budgets. Which 3 budgets? Q3, Q4, Q1 next year you will have. First update these 3. If any changes are there in the market, update them and then add another one. This is known as rolling budget. So when each accounting period finishes, this is the definition. This is the budgeting method where each accounting period means each of these periods, quarters. Okay, when one accounting period finishes, the remaining budgets are updated and one more accounting period's budget is added to the series of budgets. This is more useful in times of uncertainty. That's the main reason we do this. You want precise budget. Cash budgets, we do this. Why? We can't make mistakes. Cash flows, we have to perfectly forecast it. So we like to keep on updating it time to time. So cash budgets, we prepare monthly. We don't prepare annual budget. Then we add everything and get the annual figure. But the plan is monthly. Continuous budget and rolling budget. That's the same. Continuous budget or rolling budget. Updated by adding a further accounting period when the earlier accounting period has expired. Dynamic conditions making original budget inappropriate. I told you why the original budget might get expired, why we need this. Advantages, disadvantages, you can read it. Right, that's all about rolling budget. In the next part, we will take this question. There are a couple of questions we can answer, which we will take in the next part of the video.